Agaus of Rainstorm Group. Micheal, another great guest we have today, and I'm excited about this guest, aren't you, Micheal?
Yes, Todd's got a superpower. That's what I'll call it. Um, and I think that some people, especially who are facing some big decisions, it'll help them make a better decision today just by listening to him in a few minutes. He will share some things that you'll be like, wow, this would really help.
All right, so our guest today has a very broad background, especially in the areas of tax law and M&A. Todd Bass is a seasoned tax attorney who has represented numerous clients in the eight-figure exits spanning just about every industry. Todd began his career in a boutique firm and later worked for Goldman Sachs and JP Morgan on the investment banking side. After experiencing his own liquidity or exit event after selling his firm, Todd decided to utilize his tenure and experience in financial services world because of the transferability of his skill set. So with us today is a true subject matter expert. Todd, thanks for stopping by. And I just got to say, wow, I could sit down with you and want to have lunch because of some of the firms you've worked for and your success as an entrepreneur, first of all. Congratulations on that and still
Thanks.
doing this today.
It's been an interesting ride.
So everyone seems to be using the phrase tax strategist. What exactly does that mean?
Uh, a tax strategist is someone very in particular, right? It's someone who specializes or has a very fluent understanding of the U.S. tax code, right? And really understands how to use it in a strategic fashion to the benefit of their client so that their client is gaining this either tax advantage or tax savings, right? Which is what everyone is sort of chasing these days. But that's really a tax strategist, someone who strategically utilizes the tax code in the favor of their clients.
And you know what? A common mistake that a lot of people make is assume that their
Mm.
CPA or tax professional is a tax strategist. Many are not. Many are not. So,
And
very
that's so
important
true. And
distinction there
that's
that
that's the
Todd made.
surprise I always get when I tell people about the people I know now. I'm like, by the way, I know people that can to eliminate or reduce your taxes. And they're like, oh, I already got somebody. I'm like, really? And I should say, are you paying
Really?
taxes? Yeah, good. What were you gonna say, Todd?
Oh no, I was just to add to what Michael said, right? There are just so many CPAs out there, right? And so many clients think that their CPA has the area of tax strategy covered. And in reality, it's really just tax filing and prep, right? And the tax filing and prep is not getting them the savings. I think a lot of people are accustomed to what they've been spoon fed, which is, you can write off your home office or you can write off your travel or business expenses from dinner. There's so many other ways layered and hidden and tucked inside of the tax code that have to do with structural organization, right? Or creating new legal entities to add a layer to whatever your setup is that open the door to additional tax savings that clients don't know about. And I think the most profound thing is that, people seem to forget that the tax code was written by the people who lobby for it, meaning the tax code was written in favor of business owners and people who run businesses and run corporations, because ultimately that's who pays for the lobbying. So it's a very unique document, right? 66,000 pages start to finish. But if you know how and where to use it the right way, it can be a game changer.
Who do these strategies really benefit? Is it everyone who pays taxes, or are there certain set of circumstances that allow for a broader
It,
application of these
it
strategies?
it would be so nice, Neil, if it applied to literally everyone. But again, going back to what we just said, the unfortunate reality is it really applies more to those who own their own business or have an LLC on the side that they're running their businesses through, right? Going back to what we just said a moment ago, ordinary income is a very funny thing, and there are ways to plan around it and reduce some of it to minimize a individual's income tax exposure. But at the end of the day, the tax code is really written for the business owner.
Totally. So, what are a couple of tax strategies that you are commonly implementing amongst your clients?
So it's a great question. So there's a few different portions of the code that I think Michael and I have seen, used more commonly than others, right? There's the notion that you can use Section 163 of the tax code that covers investment interest expense to offset passive investment income that may be generated from real estate holdings or from dividends that you have. But it can also be used to offset taxes on long-term capital gains, right? And the notion is very similar to something that I think all of us are familiar with, right? And that notion is that if you have a house with a mortgage on it, right, everyone is very familiar with the idea that they can deduct the interest on their mortgage, right? And that notion goes back to if you use financing to acquire a particular asset class, the interest charge tied to the financing is considered an investment interest expense, becomes tax deductible against other types of passive investment income and long-term capital gains. So when you're able to generate and harvest those either on an annual basis or on a prolonged basis over a period of time, you create this bucket of tax deductible credits that one can use against certain types of income or gains, and you're able to offset your taxes with it. It's essentially as simple as that when you're going through the code. I think the language in the tax code is incredibly complex and confusing, as it is even for a seasoned practitioner, right? But in doing the legal analysis and figuring out what is and what isn't permitted, you can use that Section 163 investment interest expense in a very particular way.
It's interesting. Yeah, what I was going to say, it's very interesting when you brought up, and I wanted to follow up on that question when you answered this, stating that the tax code is created for businesses. And the very understand that you're missing out if you have an opportunity to have a part-time business or opportunity to create something else and maybe quit your day job at one point in time. So you don't pay as much in taxes and have an opportunity to really grow and have other strategies that it's not available for a W-2 employee.
And it's so true. And listen, you hear people complain that it's not fair that some of these billionaires pay essentially nothing in taxes, right? And in some degree, it isn't fair, but they're not doing anything wrong, right? They're using the code, or their team or their advisors are using the code in a particular way that affords them and allows them to write off more than what your ordinary W-2 income earner would potentially use.
And also remember, right, who is hiring the greater amount of labor force here in the United States? It's the small business owners.
Yeah.
So yes, there's some advantages to being a small business owner, and now you could see why.
Any business owner, really. I mean, and I think there's a hierarchy, right? Starting from an LLC or a sole prop or a consultant, right? There are a certain amount of doors that are then open and available to them from a tax planning perspective. And as that starts to scale up, right, and you move into the S corps and the LLPs and all these different legal entities and structures, more and more becomes available, right, or at the client's disposal to be able to tap into based on their legal structuring. So going back to what we said earlier, Neil, right? If you have a side hustle, right? If, I don't care if you're doing fulfillment by Amazon or you're selling online programs through Instagram or TikTok, that's a business, right? Anything that is revenue generating is considered to be a business. How you structure yourself from a legal perspective, right? Meaning entity selection, right? Tax election, how you layer those on top of one another, whether or not you have a management company that's running your business and then flowing revenue through the management company so that distributions come back as passive investment income, which is taxed at a lower rate than ordinary income. All of that, right? All of that becomes, colors that we use, right? When painting this Bob Ross picture of tax mitigation, right? I think, Michael, one of the other ones that we use frequently is this Section 453, right? The deferred installment sale. And what that allows a client to do, Neil, and again, it comes back to being the business owner, having an exit event, having some type of liquidity event where you're selling an entity or an asset, right? Which, sometimes an ordinary income earner or W-2 employee, they may buy real estate, right? And when they divest or sell that real estate, they can make a 453 election and use this deferred installment sale structure. But what it allows the client to do is, let's say you were selling some sort of asset for $10 million, right? Forgetting whatever the local state long-term capital gains tax rates are, On the federal level, there's roughly about 23.8%, right? Long-term capital gains, FICA, net investment income. You're roughly paying about a quarter in capital gains. So at 10 million, that's 2.5 million right off the top, right? If you were to make a 453 installment election, what the code allows you to do is say, I'm not going to realize that full $10 million tax exposure or tax liability in a given year. I'm going to set up an installment structure, right, with an entity that is not the buyer, right? And I'll come back to that in a second, but I'm going to take $1 million a year for 10 years, or $2 million a year for 5 years, or $3 million a year in the first 3 years with $1 million in year 4. It allows you to break up that $10 million sale so that you don't have a $2.5 million tax liability in that calendar year. Now, a lot of people might say, well, I don't like installments. I don't want to have to chase the buyer. They could die. They could go bankrupt. In the 453 deferred installment structure, there is an intermediary, right? Very similar to the way there is a qualified intermediary in a 1031 exchange, which most people are very familiar with. There's an independent intermediary in between both the seller and the buyer, right? The buyer is still responsible for remitting or tendering the full amount, so the 10 million. That 10 million would go to this intermediary, right? Who is typically an attorney. They're licensed, they're bonded, they're not running off with your money, right? And again, full disclosure, do your research, know who you're dealing with for obvious reasons. But this intermediary then takes custody of the money. They will put it into things that are very conservative, like treasuries, right? Or bonds, or, potentially the S&P, the ETF, right? But they will then make these distributions plus interest, plus the yield to the client on an annual basis. When those distributions are made, right, that is when there is a realizable tax event. So rather than having to pay, sticking with that 25% assumption, rather than paying 2.5 million in the year of a sale, now you're paying 250,000, right? Now one might argue, okay, 250,000 over a 10-year period, still the same 2.5. It is. However, you're not paying the full 2.5 up front. And if you go back to some of these tax strategies that we're discussing, you then have the ability or the runway to implement some of these strategies and make mitigating that tax exposure more palatable, right? It'd be very hard to offset a $10 million capital gains in a single year, especially if the client comes to you in Q3 or November, or when a lot of clients like to come to you, which is the end of December. But implementing this deferred installment sale structure allows them to synthetically but organically elongate that time frame in which they receive the money, and that allows them to implement tax strategy to offset their capital gains. Mm-hmm. There happens to be a very interesting subsection of 453, right? It's known as 453 capital A. This strictly pertains to people in really, I shouldn't say middle America, but anywhere in the country that own agricultural land, right? Or are cultivating the land or harvesting the land. In a normal 453 structure, right, when you set up these installment agreements, you are not allowed to accelerate the monetization of that note. So if you and I, Neil, enter into an agreement and you're supposed to receive $1 million for 10 years, at no point can you accelerate that $10 million. If you do, it becomes taxable immediately. For people who own agricultural land or are harvesting the land, they're allowed to enter into the exact same 10-year agreement, right? Or longer if they want it. In most cases, they'll set it up as a 30-year, 0 payments for years, 1 through 29, and a balloon payment in year 30. But an agricultural landowner or a farmer or rancher is allowed to take that installment note and the very next day bring it to a bank and monetize the note, right? It's something known as a monetized installment sale. The reason they do that is now that note is very similar to refinancing your house. The money you receive from that bank is in the form of a loan, which is debt and is not taxable. So they just receive the majority of the loan proceeds instead of receiving sale proceeds, which would be taxable. They just got the majority of that transaction tax-free and don't have to worry about any kind of tax liability for 30-something years.
Mm-hmm. This is powerful stuff, Neil. Especially there are, when you consider that America's strongest economic group is getting older by the hour, it seems, and a lot of them are looking at exits. This is really powerful knowledge here. If they could really harness this and apply it to their situations.
Totally.
Yeah.
you want to also talk about premium financed life insurance.
Yeah. So, and this is something that Michael and I deal with very commonly. I think that for a long time, there's sort of been this negative or dark cloud that has hung over the insurance industry as a whole, right? I think that no matter what industry you want to talk about, there's always bad actors, right? There's bad actors in the accounting profession, the legal profession, the insurance profession. There's bad actors in churches. There's bad actors everywhere, right? Insurance has, for the last 2 centuries, we'll call it, been afforded this very favorable tax treatment by the IRS and the government. Why? Primarily because the majority of Americans rely on it to take care of their family when they're no longer here. People use it in times of economic or fiscal distress. But the point being is that life insurance as a whole, as an asset class, has been given and afforded this very favorable tax treatment. When you combine that with certain portions of the tax code, right? And then you introduce this notion of financing, which we discussed before. You create a vehicle, right? Or an instrument that allows you to, one, own life insurance as an alternative asset class, but two, create these investment interest expense deductions that you can use against some of your investment income, right? And that investment income, again, can either be dividends from stocks, it can be rental income from houses that you own, it can be limited partner K1 distributions from certain investments that you have. But this financed life insurance concept, right, provides so much more than what people initially believe, right? And I think everyone has this preconceived notion that life insurance pays when you die, right? But what they don't understand is all the other internal working mechanisms within the life insurance chassis that really have these living benefits, not just from a tax perspective, but from a cash flow perspective and also from a planning perspective.
So just a
Wow.
couple of thoughts real quick, and Todd, you're the perfect person to correct me if I'm wrong on this, but I can't find other financial instruments that enjoy the tax favor treatment that life insurance is cash value life insurance has. That's number one, and with respect to, you're talking about the 453, whether it's A or the 453, time. You've bought time, right?
Yeah.
You by stretching out your tax liability over, in his example, 10 years, there are a lot of things you could do over that period to continue, right? To build your wealth. Because what Todd's talking about with premium finance life insurance is now, instead of paying a tax, you have the opportunity to build your wealth simultaneously.
In a
But it
tax-free fashion
requires
as
thought.
well.
Yeah.
Yeah, I think you hit the nail on the head, Mike. And there aren't many other financial instruments out there other than, maybe muni bonds and treasuries, right? But when you're dealing with those, you're either dealing with low grade bonds, right, from municipalities that don't have the economic strength, or the treasuries, right? We all know where the interest rates on those are right now.
Right.
But life insurance is this very funny unicorn that has exposure to the S&P, um, and realizes this untaxable treatment if it's structured and owned the right way. And when you have an instrument that can grow and appreciate and compound year over year without having any of that growth or appreciation taxed on any level, the growth becomes exponential, right? And to what you said before, if you can use that in conjunction with the tax favorable treatment that we're able to create through these finance life insurance structures, you've created something for yourself that is so supercharged and just hits on so many different levels, right? But time, I think, is the most important thing. And the one thing I want to point out is I know we use 10 years as an example here, but in 453, the business owner who's making the election can do anything that's more than 2 years. They can go as far out as 50 years, and they have the ability to control the amount of the distributions and what those distributions are, with the exception of whatever the yield may be or the return on the corpus. But 453 with that pertains to agriculture is really, I want to say, the closest thing to a gift that the IRS has ever given to any group of people.
So how soon should someone looking to do tax planning initiate the process?
I mean, a lot of the times it's as soon as possible, right? If you're a business owner and you don't plan on exiting or selling your business for the next 10 or 15 years, believe it or not, you're at the point where you need to sit down and start to do the planning now, right? And we always preach being proactive versus reactive, right? Sitting down doesn't mean that you're selling the business, doesn't mean that you're doing anything that is irreversible or can't be changed. A lot of these plans require annual maintenance to begin with. So we're checking in on a quarterly basis and making sure that things haven't changed materially. But I think sitting down as soon as you realize that you are going to have some sort of large taxable event, whether it be in the next 6 months or it be in the next 16 or 20 years, sitting down when you know that you have an issue is the most important, right? If you're selling a business in 6 months, can we still do something? Absolutely. It may require some additional legwork and speeding things up a little bit, but as soon as possible, right? But as short as 6 months or even 3 months.
Wow. It's very interesting when you talk about when to do it or not do it. They always got a plan as a business, right? Because is it a sellable business too, Todd? That's something
And
people should look at too. Go ahead.
yeah, and the funny thing is, I had this conversation with a CPA last week doing some year-end planning. We're all sort of conditioned as humans to start planning for retirement 20, 30, 40 years out, right? Why wouldn't you do it with the sale of your business? Or why wouldn't you do it with the sale of any asset that you hold in your portfolio, right? If you own real estate and you don't plan on selling it now, if you have any intention to sell it at any point, right, having an exit plan in place now is always going to be better than having an exit plan in place 3 months prior to the exit, right? It just, I always make the comparison to a bottle of wine. It allows the strategy to really open up and breathe. And the longer you give the strategy to open up, the more powerful, the more of a positive impact it's going to have later on when you do experience that liquidity event.
Totally. Because when it happens, you got to be ready. It's
That's
unreal to think about those things. Yeah.
it is a bit unreal, and people say, well, I'll deal with it next year. I'll deal with it as I get closer. If you see the potential exit in plan or as a feasible outcome, the idea is to start the plan now, right? There is no such thing as too soon, but there is such thing as too late.
Too little, too late. We don't want to say
Yep,
that for sure.
yep,
Are there
exactly.
any recent cases or clients you've worked on that have had a profound impact?
Yeah. The most recent had about a $40 million impact. A family out of the West Coast that we work with has been very successful in accumulating multifamily real estate. And it's funny, this whole conversation is sort of revolved around capital gains, but the idea here is that they never wanted to sell any of their real estate. They wanted to maintain it in some sort of legal entity or trust structure. But at the end of the day, there was investment income that was being generated from these real estate assets that they owned. And the more important problem was that because of the success that they've had, ultimately, when the husband and wife pass, they're going to owe the federal government roughly $60 million, right? That will be their federal estate tax liability in about 20 years from now, if not more, depending on whether they continue to acquire and accumulate assets. The savings came in when we sat down with them and really started to address the passive income that was being generated from the real estate. We realized that the $60 million estate tax issue is much bigger. In putting together one of these financed life insurance vehicles, right, the interest charges that they will have paid over a 12-year period will have come out to roughly about 18.3 million over 12 years, right? So you can do the math, but 18.3 million before tax deductions versus $60 million was roughly about a $43 million tax savings to the estate, which is really what we were trying to plan for. What that meant is now when the husband and wife, the mother and father pass away, the children will not have to sell off real estate in order to have to pay the federal government what the estate tax liability is, right? Typically, after the second passing of a mother and father or a spouse, the federal government gives you about 9 months to pay the federal estate tax, whatever it may be. If you don't, they will come knocking and they will start basically inventorying all of your assets and they will start selling them. And as you sell them, you incur additional capital gains. This family avoided having to sell roughly $100 million worth of real estate to cover their $60 million liability. So yeah, just as of about 2 months ago, we started to put this plan in place for these clients. And when we realized what the impact of the savings was at $40 million, it was incredibly profound.
They must have been really surprised, right? Because they're consulting with you for another reason, and you were able to figure this solution out.
Yeah, and it seems more complex than what most people are prepared to sort of take a bite out of. But to kind of just clear the air, right? This whole premium finance notion, it's nothing more than a financing component, right? Or strategy combined with life insurance, right? Most people are used to, when I buy life insurance, I pay for these premiums out of pocket from my money, and that's the end of it. And that can be incredibly expensive. Premium financing, right, is very similar to the mortgage analogy that I gave you earlier. Many people might be able to go out and buy a house because they have the cash in their bank account, right? But no one would ever really go and do that. Most people might, but a lot of people would utilize a mortgage. Premium financing is utilizing a mortgage to purchase a very large or substantial size life insurance policy, right? And what we're talking about is using that interest charge similarly to the way people would deduct their mortgage interest, right? Under that Section 163 investment interest expense. So premium financing is nothing more than life insurance and using financing to pay for it, right? And what that does is, just to give you an example, right? If you had $1 million annual premium, even if interest rates were at 6%, which they're not anymore, rather than paying $1 million a year, you would pay 6% on that outstanding balance, right? So in year one, you're only paying $60,000, and you're using that in a tax advantage, tax strategic way. Year two, when the second premium is paid, now it jumps to 120. Then in year three, it would go to 180. But in the long run, right, if you did it over a 10-year period, rather than spending $10 million in premiums, you would have spent a fraction of that, and you would have been able to use it against any of your other passive investment income as well.
Wow. Micheal, what do you want to add to this? This is just fascinating
Well,
information.
just on the topic, the word time keeps coming up. So oftentimes, you kind of touched on it, Todd touched on it, and we've discussed this in previous programs. Business owners are so busy that they put this decision off. They wait and they waste so much time when they should start thinking, okay, so I'm already considering selling my business. There's somebody interested. That's the time to start thinking about this, talking to people like Todd, and getting some advice, because at a certain point, it's too late. Todd knows. I've called him a couple of times with clients that were already the client already sold. There's nothing we can do.
That's another big thing is the money.
Yeah.
If the sale takes place and the money transacts and passes hands to the client, at that point, it's been realized. So it is so important that the planning be done ahead of the closing. We just had a client on an agricultural land deal who came to us 4 days before the closing. And we were able to adjourn the closing by 48 hours, so that we were able to get all of the documents and entities in place to be able to execute on this 453 capital A structure. But it was almost too late for them.
Mm-hmm. And there's a real investment in time to understand exactly what Todd's talking about.
Right.
But when you consider just the one example he used, $40 million in savings, how much time are you willing to invest to save $40 million, to keep that in your pocket? It sounds funny, but some people are like, yeah, I guess I got to do this now. You got to talk them into it.
Exactly. So anyone listening to this live stream, watching the live stream right now, and it's last TikTok, the best thing to do is go ahead and DM Micheal or I, or listening on the radio show. But if any other way, you're going to go to rainstormmediagroup.com, and there's going to be a page for Todd that have contact information, so we can enter that contact information and schedule a call with Todd.
Yeah.
All right.
For sure.
All right. Appreciate it, Todd. Thanks again.
Thank you, Todd.
Opportunity.
Great
It was
chat.
great.
Thank you guys.
Great information. All right.
Happy holidays.
Happy